Welcome to the Deep Dive, the only analysis you need to fully understand the strategic implications behind the headline numbers.
We're Talk Tickers, and today we are breaking down a Q4 earnings call that was just, well, exceptional.
It really was. We're diving into the fiscal year 2025 results released on December 18th. The call itself was the next morning.
And the market loved it. I mean, the stock jumped over 6% on the day, which tells you a lot.
It does. But before we even get to the numbers, we have to talk about the context here.
Absolutely.
The call came shortly after the passing of the chairman and CEO, Lorenz Mendelsohn, and the transition to his sons, Eric and Victor, as co-chairman.
And they started with a tribute, a really powerful one. It highlighted the culture he built there.
Which is so important to understanding how they operate. This focus on fairness, excellence.
And what he called real earnings. That's the key phrase. For them, it's all about cash flow.
Right. It's about cash and EBITDA, not just, some of the artificial GAAP metrics that can hide what's really going on.
Exactly. They run it like a private equity firm. It's about cash generation and then deploying that cash.
So let's see how that DNA, that philosophy, translated into the results. Because they were record results.
A huge beat. The headline figures for Q4, GAAP EPS came in at $1.33 diluted.
And the consensus was what, $1.22?
$1.22. So they beat by 11 cents. That's a 34% increase year over year.
Just massive. And the revenue side was just as strong.
It was. Net sales hit $1,209.4 million. That was almost $40 million ahead of the forecast.
That's 19% top line growth. But what really stood out to me was the quality of that growth, the profitability.
Yes. This is where it gets interesting. The operating income grew even faster than the revenue.
Faster.
28% year over year, up to $279 million. And we saw the operating margin expand by 150 basis points.
So a full percentage point and a half.
Yeah.
For anyone tracking efficiency, that's the number that tells you they're getting real leverage as they grow.
And then there's the cash, the thing they care about most.
It surged.
It surged. Operating cash flow was up 44% to $295.3 million.
So why the huge jump in cash? Is it just scale, or are they managing working capital better?
It's mostly scale and efficiency, but you're also seeing the synergies from acquisitions like Wencor really start to kick in.
I see.
It's just massive operating leverage. And that cash surge has huge implications for their M&A strategy.
Okay, so tell us about the balance sheet. This is where the market starts to get excited about the future.
Well, that cash generation machine is just working overtime to pay down debt. The net debt to EBITDA ratio, it dropped to 1.60.
Wow. And that's down from what, over 2 times a year ago?
From 2.06x, yeah. So to deleverage that quickly while still doing M&A, it gives them immense firepower for the next deal.
So if cash is king, let's look at where it came from, starting with the Flight Support Group or FSG.
This is the organic growth engine. The performance here was just stellar.
New records, I assume?
New quarterly records, net sales up 21%, operating income up 30%. But the critical number, the one you have to focus on, is organic growth.
And that was?
A tremendous 16%. And it wasn't just one product line, it was across the board, especially in aftermarket parts and repairs.
The margin story in FSG seems to be the real headline. The operating margin went up to 24.1%.
Up from 22.3%. And you have to ask, how is that sustainable?
Right, in this environment.
It's sustainable because of their value proposition: speed, quality, and lower cost. Remember, FSG specializes in PMA parts.
Parts manufacturer approval. FAA approved, but cheaper than the OEMs.
Exactly. And management said explicitly that organic growth accelerated because other manufacturers are jacking up their prices.
So the inflation at the big guys is a direct tailwind for them.
It's a massive tailwind. It makes their parts look like a bargain for airlines and for the military. They're solving a huge cost problem.
That makes perfect sense. Okay, let's pivot to the Electronic Technologies Group, ETG. Also a record quarter for them.
Also records, yeah. Net sales up 14%, with about half of that, 7%, being organic growth. Operating income up a strong 10%.
And what's driving that?
It's mainly demand in defense, aerospace, and some of their specialized space products.
The margin profile here was a little different, though. I saw a slight compression.
A slight one, yes. GAAP operating margin went from 24.3% down to 23.3%. Management said it was due to higher compensation expenses.
Should we be concerned about that?
Well, this is where you have to go back to that real earnings idea. While the GAAP margin was down a bit, the cash margin, the EBITDA margin, was excellent, 27.3%.
So they're saying, look at the cash, not the non-cash expenses that come from M&A accounting and things like that.
That's exactly what they're saying. The underlying operational performance is still superb.
Speaking of margins, did they give any kind of long-term outlook for FSG?
They did. They gave very clear goalposts. They expect FSG's GAAP operating margins to hover between 23.5% and 24.5%.
So that's the new normal.
That's the new normal. And they think they can add another 20 to 30 basis points a year just by leveraging their fixed costs. So 24% is really the floor now, not the ceiling.
Okay, let's talk strategy. The other half of the flywheel is M&A.
And the pipeline was described as very strong and busier and busier.
Which goes right back to the balance sheet.
Exactly. With leverage at 1.6x, they have all the firepower they need. They even said they'd be willing to spike leverage up to 4, 5, even 6 times for the right deal.
6 times leverage. That's an aggressive statement. Doesn't that introduce a lot of risk?
It sounds like it, but they pointed right back to the 1.6 number. They said, look, we've proven we can generate the cash to delever in 12 to 24 months.
So trust the track record.
Trust the track record. They see themselves as the buyer of choice in their niche. I mean, 110 acquisitions in 27 years, they know what they're doing.
Let's talk about 2 of the recent deals. First, EthosEnergy A&C.
This is a classic move for them. It expands their Wencor business into parts and repairs for industrial gas turbines.
Okay.
But here's the kicker. Management explicitly framed this deal as supporting the global energy demand that is being, and this is a quote, fueled by the AI revolution.
Wow. Okay, that is a fascinating connection. So they're taking their core skill-making aftermarket parts for turbines and pointing it directly at the data center boom.
It's a massive non-aviation growth story that just opened up for them. A huge thing to watch.
And the second deal, Axillon Fuel Containment.
That one adds a military spec fuel cell business that's tied to major defense platforms. So again, a high margin niche business. And both of these deals are expected to be accretive within a year.
So adding to earnings almost immediately. Now, despite all this, they still won't give formal annual guidance.
No, they never do. They say their internal budgets are too conservative to be useful for Wall Street. But they did reiterate their main goal, their multi-year target of 15-20% bottom line growth in net income and EBITDA.
Let's touch on the defense posture. This is clearly a big driver for them.
A huge driver. They're perfectly positioned to offer high-quality, lower-cost alternatives for military aircraft. They have a massive advantage in speed and cost compared to the old cost-plus model.
Right, the cost-plus model, where the OEM just charges their cost plus a guaranteed profit. It's not very efficient.
Not at all. And this company injects some much-needed competition into that system, but they're also selective. They avoid what they call profitless space ventures.
And this brings us to this name that came up on the call, Golden Dome.
Golden Dome. Yeah, it sounds very mysterious.
What is it?
Well, they described it as a suite of classified recon and surveillance programs that a bunch of their businesses are contributing to. The details are obviously secret, but
the fact they even mentioned it tells you it's a significant and growing source of revenue that wasn't on the market's radar before.
Exactly. It's an additive growth vector in defense.
Okay, let's switch back to commercial aviation. The aftermarket tailwinds seem as strong as ever.
The fundamentals are rock solid. As management likes to say, older fleets are aging 1 year per year.
Hard to argue with that logic.
Right. But it makes the point. Their business isn't dependent on Boeing or Airbus hitting their delivery targets. It's dependent on the millions of planes already flying that need constant repair and parts.
And what about the new engine platforms?
Yeah.
The LEA, the GTF?
Well, the opportunity there is limited while they're under warranty. But as soon as those warranties roll off, their engineers get to work.
Finding ways to make cheaper FAA-approved parts for them.
Exactly. It's a guaranteed long-term pipeline of future business as the global fleet modernizes.
And they also mentioned expanding PMA into the military sector.
Yeah, they called it a medium-term opportunity. The government is finally getting serious about cost efficiency, and using already approved commercial parts is a great way to save money.
But government can be slow.
Notoriously slow. But they're bullish on the long-term potential. It's a huge future market for them.
So the stock was rewarded, up over 6%. The market is clearly pricing in that 15-20% growth. What's the risk here? What's the key watch point?
The watch point is just valuation sensitivity. Because they don't give guidance, the stock can get sensitive to any kind of deceleration narrative, even if it's just based on a temporary slowdown or a conservative analyst model.
They just have to keep executing.
Execution is everything at this multiple.
All right, before we wrap, let's look at a potential trade they basically highlighted for us. But first, the usual reminder.
Yes, this is not financial advice segment, A vital disclaimer: we are not licensed advisors. This is for informational and entertainment purposes only. Do not take this as a recommendation.
Understood. But if we were going to pitch an outrageous but plausible idea based on what management themselves said, it's all about the two share classes.
The Class A common stock, HEIA, versus the common stock, HEI.
Tell us about the setup.
It's a classic market inefficiency. The two stock classes are economically identical, same dividends, same claim on earnings, but they often trade at different prices.
So the pitch is simple.
Management made the pitch for us. They called the Class A stock a screaming value. They even pointed out that directors were buying the A shares.
So the trade is to go long the undervalued Class A and maybe short the regular common stock as a hedge?
It's a pure convergence play. You're betting that, as management put it, a rational market will recognize that and push them together.
Okay, so what does this all mean for you? The core takeaway here is a record quarter. You have a powerful 16% organic growth engine, smart M&A, and just surging cash flow that has brought their leverage way down to 1.6 times.
But the really strategic, forward-looking piece is the biggest insight. That EthosEnergy acquisition was explicitly linked to supporting the energy build-out required by the AI revolution.
And that leaves you with a final provocative thought to consider. Are these deep aftermarket aerospace companies the ones that are masters of high-quality, lower-cost parts for turbines? Are they the unexpected infrastructure play on AI?
It suggests their future growth might have less to do with aviation.
And a lot more to do with keeping the lights on for the next generation of data centers.
A very compelling idea.
Absolutely. Thank you for joining the deep dive. We'll catch you on the next call.